Okay, so in order to get started with our conversation about securing and leveraging a loan, we have two amazing experts to guide us through our conversation. First, I'm excited to introduce Lindsay Chung. Lindsay is a senior business advisor at Accion Opportunity Fund and has more than 13 years of experience in the accounting and finance industry. Lindsay has worked with hundreds of small business owners across more than 20 different industries, from startups to established businesses. She has helped businesses understand their credit and ways to improve it, along with advising them on how to manage their cash flow, analyze their financials, and improve their bookkeeping practices. Lindsay first realized her passion for economic empowerment while proudly serving as a Peace Corps volunteer in Botswana. She has a Bachelor's of Science in Business Administration, Accounting, and Finance from the University of Colorado and currently lives in Denver. It's great to have you here, Lindsay.
Thank you for having me here, Brittany. I really appreciate it.
Wonderful. And next we have Chad Patterson. Chad is a business executive and strategic visionary with over 15 years of experience in finance, sales, and marketing. Chad has successfully founded three ventures and is passionate about helping small business owners and entrepreneurs scale their ventures. It's great to have you here, Chad.
Likewise, great to be here. Hello to everyone.
Wonderful. And you might notice in the chat, we are going to have a couple of session links. So as you're hearing the conversation today, if you want to stay connected or schedule your own session with Lindsay or Chad, you can do that for free. So Lindsay, I want to start with you. When preparing to secure a loan, what are the most important things business owners should have in place? And how might those preparation steps look different for someone earlier in their journey versus a more established business? And then any common pitfalls you see across businesses applying for loans?
Yeah. Well, I'm so happy to be here. Thank you all for joining us here. Uh, that is such a complex question, so I did put together some slides just so you have something to follow throughout this part of the presentation today. So I am so excited to be here because I'm very passionate about access to capital and supporting small businesses. I feel like having a solid financial foundation is critical to a small business's success. Most small businesses fail because of cash flow constraints. And so I'm excited to be here with you today to figure out how we're going to overcome some of those challenges and grow your business. This is something we never learned in school. So we want to make sure that we can break it down and demystify it for you. Okay, so we're going to start with some basic foundations. This is how a lender evaluates your application. So they generally look at the 5 C's of capital, and each lender weighs these different 5 C's a little bit differently, but all of these things and continuing to strengthen these things will continue to give you access to more affordable capital and just more capital options in general. And so the first one is generally around character or credit. This usually is how they measure your reliability. So most lenders rely pretty heavily on that credit portion. And oftentimes, especially in those earlier stages, they do look at your personal credit. So building up your personal credit is a bridge to get you into more business credit and to start building that in the future. If you do have bumps on your personal credit, I would recommend starting to work on that earlier rather than later. There's great nonprofits out there that offer free credit counseling and tools to help you bring down your credit utilization rates or things of that sort. One of those organizations is Money Management International, and we can definitely share their information with you if you're interested. There's also Trust Plus and a number of other organizations. We actually also just added a credit course and Learn with AOS. So that's another place where you could maybe start strengthening your personal credit. And then it's always good to start building your personal credit. So once you open up your business, make sure that you get an EIN and start trying to build that up with business credit cards or other types of capital. And that will really help improve your chances as you kind of move forward in your business. Another important piece is capacity or cash flow. This is how a lender measures your ability to repay on the loan. And so, oftentimes, for startup businesses that don't have any revenue or much revenue coming in, they can rely a little bit more on financial projections and personal income when they're evaluating this decision. Where for existing businesses, oftentimes they're kind of looking at historical financials. So they'll use bank statements or profit and loss statements or any financial statements, tax returns, things of that sort to really put together the full financial picture and get a better understanding on whether you have ability to pay on the loan. Oftentimes, for existing business owners, they'll calculate something called a debt service coverage ratio. And this just figures out how much money you have left over after you paid all your expenses and compares that to your current and future debt payments. Generally, lenders want to see that you have at least $1.25 in income left over after paying your expenses for every dollar of debt payments that you will have. So that's a good kind of rule of thumb. They'll also oftentimes have a rule of thumb related to kind of how much you may qualify for. Here at AOF, we generally lend about 10 to 20% of what your annual revenue is. So that can kind of give you an idea of what you may qualify for when looking for a loan. The next one is capital. And so this is especially important for earlier stage businesses. This measures your commitment. This is similar to kind of like a down payment on a house. Generally, if you're starting a business, lenders want to see that you've invested or have about 10 to 20% of what you're asking for to start the business available to invest in your own with your own personal funds. And then if you're an existing business, generally they look at your equity. They just want to make sure that you have something in the lines on the line. So if things don't work out exactly as planned, that you're not just going to walk away, that you're going to really fight for your business and do the hard things to make sure that the business succeeds and that you pay back that loan. The next one is around collateral. So collateral is something that you own that you're willing to pledge to the loan. And so if you default, the lender is able to take that back. Different lenders have different collateral requirements, so it's important for you to decide what makes the most amount of sense for you as far as collateral goes. It can be really helpful, especially if you have bumps on your credit, to kind of mitigate the risk for the lender. One of the most common forms of collateral is a UCC lien, which is a Uniform Commercial Code, and this is a lien on your business assets. So they're able to take them if the business doesn't work out. The last one is around conditions. So this is the overall conditions of the loan and generally kind of a catch-all bucket for everything that wasn't covered in the previous one. So they'll oftentimes look at things like your time in business. So the longer you've been in business, the less risky you appear to the lender, or your expertise. If you haven't been in business for very long, it tends to be a little riskier. So they want to understand that you kind of know some of the tips and the tricks to the trade, and that they're not going to pay for you to learn that the hard way. So they typically want to see that you have about a year or two of industry experience, ideally in a managerial role. Another thing that they'll look at is the type of industry that you're in and different trends in that industry. And so, if you are in retail or restaurants, that tends to be a little harder to get financing just because they're deemed as more risky industries, where in the past, professional services has been seen to be a lot less risky. Although with AI, that may be changing things a little bit. I guess we'll have to see what the total impact of that is, but your industry will play a role in their decision making. Also, the use of funds is important, so it's great if you can kind of lay out what the use of funds are for your business and what you're going to use those for and turn those funds into. Like, what is your return on investment going to be on that? Different lenders look at different uses of funds differently. So it can be harder to maybe get someone to refinance debt than it would be to have somebody help you buy inventory because you can't keep up with demand. That inventory, you can easily sell that off and turn that into revenue, where that's just not the same when you're refinancing debt. So it's great if you can be fully capitalized earlier on and make sure that you have, like term loans or things of that sort, can really help you have that long-term growth. And the final thing they think about is just economic conditions and interest rates. Things that are somewhat out of your control. Luckily, interest rates just dropped a bit, so that definitely plays in your favor. So overall, lenders are going to take all 5 of these C's and they're going to decide whether it's a yes or a no, and then they're going to decide what type of rate that they're going to give you and what type of term for the loan they'll give you. And that's, the length of the loan, so how long you have to pay it back. So it's important to always continue to build these, even if you get a loan and you don't plan on getting one in the future, or you just don't know if debt's right for you. It's always good to strengthen these because we never know what's going to happen in our business. Okay, so here we went over some of these things, but I really want to highlight these important items related to early stage businesses and helping to get prepared for funding. It's always important to build your track record. So track all your expenses, track all your revenue, and have a clear path on kind of what success is going to look like for your business. A strong business plan is very important in those earlier stages if you're looking for capital. This is how they're deciding if you're going to be able to pay back the loan. So you need to show that you've done a lot of research. You understand the needs that small businesses have, your solution to those different problems, and you need to make sure that you have financial projections that aren't too overly optimistic. You want to make sure they're really realistic, based on industry averages, and that you have very clear assumptions. So you say why you assume that you're going to grow at a certain rate per year or things of that sort, so that the lender can kind of dissect these different assumptions and see if they agree with those assumptions. So a strong business plan is a really important foundation when you're first getting started. And it's good if you can do that yourself. Some people ask if they should do it all through AI or, hire a professional. And my personal opinion is it's kind of more about the journey than the destination. So it's great to have a business plan, but part of what makes it so valuable is that you went through and you did those exercises and you talked to people and you learned what would work and what wouldn't. And you understand all those numbers so that if numbers aren't the way that you thought they would be, you understand more of why that is. And so strongly encourage you to build out a business plan, and we have support here to help you do that, but that's going to really improve your chances of getting that loan. I always encourage people to separate business and personal finances. I know this can be really challenging when you're first starting because cash flow is tight. And oftentimes, you're robbing Paul to pay Peter, things of that sort. But I strongly encourage you to go start a relationship with a bank, find a great business bank that offers all the things that you're going to need to grow, and start building that relationship. Get the business bank account, see what it takes to get a credit card with that bank, and really separate things as much as you can. This not only helps you make really solid financial decisions, it also helps save money with your accountant during tax time. They don't have to sort through all these different transactions. They can have a really clear picture of your business and where everything went right off the bat. And it helps a lender understand that you're taking your business seriously, and it helps them get a clear picture of really what's coming in and what's going out, which is very, very important when they're trying to underwrite the loan. A personal investment, so it's always good to save up money before starting a business. A lot of businesses aren't profitable in the first year or two, and so in order to, make it through that period and have long-term success, it's always good to have some sort of runway. Whether you're just starting out or if you're more existing, it's always good to have that available. So just make sure that you keep that in mind. Additional income sources can be helpful in those earlier stages. Oftentimes, when you're just getting started, your loan is personally guaranteed. So that means whether the business succeeds or not, that you're still responsible for that loan. And so this just shows that you'll be able to pay on it no matter what. And I know people sometimes are really eager to quit their jobs, but if you can keep that as long as possible, or have somebody who's willing to co-sign on the loan, who has an additional income, or you have enough savings to kind of float the business for a while, then you should be good to go on that one. And then just make sure you're documenting any growth trends. You'll see probably throughout this presentation that I'm really passionate about knowing your numbers and tracking things and understanding what they mean, and using that to really make informed business decisions. So as your business grows, you get access to more affordable capital because you become a little bit less risky, but lenders kind of look at different things. And there's different ways where you can kind of show the success of your business outside of kind of the more traditional methods. So showcasing growth trends is really helpful for them to understand. You know, they're just getting the small picture of your business. So if you can kind of help them understand what it means in the full picture, I think that that will go a long way in showing the growth and the potential of the company. It's important to leverage vendor relationships. So if you've had a great relationship with a vendor for a long time and you have positive payment history with them, that always helps to show that you have the ability to pay. Demonstrate business credit. So it always helps to start building business credit early on. So it starts with kind of a business credit card and goes from there. Some credit bureaus will allow you to provide some of the documentation that you've paid successfully on different relationships and different financial documents to help you build up that business credit. So the more you kind of build that up, the higher chance that you will be able to get a loan without a personal guarantee in the future. And then always highlight, you know, your customer base. It's a really good sign. If you have repeat clients that buy from you more than 2 times, that really shows that that product market fit that you have. And so collecting that, testimonials, things of that sort can be really important in showing, you know, how much support you have for your base. From your base. It can also be helpful, you know, there's a lot of different funding sources, but that can also be leveraged for doing crowdfunding or different things of that sort. Here are some essential documents just to give you an idea about what some lenders require. It really depends on the lender. There kind of is a range that they'll ask for. The most basic stuff that they'll ask for is an ID, tax returns, and bank statements. And so make sure that you have those ready and available. If you're a startup business, they'll definitely ask for a business plan. They'll often ask for some personal financial information. So be ready to kind of share that. And then as your business kind of progresses, they'll ask for more and more financial statements, AR aging schedules. They might ask for contracts or leases or things of that sort. So just be prepared to have all that document ready. What I've seen is that tends to be one of the longest periods in the loan process, is just collecting all those documents and going back and forth with your lender to make sure that you have all the documents in place. So just make sure that you have all of that stuff available and just be ready to explain anything that may be crazy or different on your tax returns. Oftentimes they're looking for trends, and if you're, you know, in a low season, it's important to explain that and have documentation to show that that's kind of normal for your business this time of year or different things of that sort. So just be ready to talk about things that may be on your credit report or your financial documents. So we know this isn't possible, but I would start planning well in advance. When you're looking for funding, it's always good to review your credit reports. So on the personal side, you do have the right to get them every year for free at annualcreditreport.com. And that should pull them from all three. So you kind of know what the lenders are looking at and you can address any issues. There is a large amount of fraud out there. You want to make sure that there's nothing on there that you weren't aware of ahead of time. Make sure you're kind of organizing your financial records. You're looking at your banking history, things of that sort beforehand. And then 3 to 6 months before, you know, make your business plan, do your financial projections, gather any documents that you need, and start beginning to research lender options. And we'll talk about some different options that are available, but it's really important that you find a lender that you want to build a relationship with. oftentimes more likely to get financing if you have that prior relationship. And so make sure that you're finding one that you feel comfortable with and you trust, and somebody who's kind of going to be able to grow with you. Then 1 to 3 months, make sure that you have it clear about what your needs are, prepare your loan use statement, and start completing the application requirements and talking with lenders. I do recommend kind of coming up with a list of questions that you may have for a lender. It may be asking if they have prepayment penalties, understanding, what the true cost of the loan is or the APR. It may be asking if they report on your personal or your business credit. So coming up with those questions and figuring out what you want in a lender and applying. Most people maybe don't know that for a lot of SBA loans, which are loans that are guaranteed by the Small Business Administration, need to be approved by the lender, and then it needs to go to the SBA for approval. So this generally takes a long time, and I've seen this take anywhere from 2 to 5 months. So just be prepared for that and maybe have a backup plan in case things don't work out like you plan. So starting earlier will really help you. Having to rush, oftentimes when you need funding, it's going to be really expensive if you need it in a short amount of time. We always pay for convenience, and loans are kind of no different in that case. And then, make sure that you're following up and you're responsive to the lender and their different needs and things of that sort. I know it can be frustrating to kind of go back and forth, but just make sure that you have the capacity to handle all those. And then hopefully get funded, and start planning on, how you're using those funds and things of that sort, which we'll explore later on. So, um, when we're thinking about getting a loan on the personal side, I think we always think about just going to our bank, but that's not always the same for a small business owner in those earlier stages. Some banks tend to prefer businesses that have been in operation for 2 or more years, and oftentimes are have really strong Cs, like what we talked about earlier. They oftentimes like to see a lot of collateral or cash flow or credit, and you may not have those in the earlier stages. So most startup businesses actually start by being funded by the entrepreneur themselves or by friends, families, groups of that sort. And so keep that in mind when you're kind of planning out. There is SBA 7A program that's available through some organizations, but oftentimes people get started through these other sources. There is more and more things available. There's crowdfunding or grants or angel investors, kind of depending on your situation or what works best for you. So there are a number of ways to kind of get creative on how to fund your business. One thing I would kind of advise against is not doing it all on personal credit cards. I've seen a lot of small businesses put all their expenses on their personal credit cards, which increases their utilization, which brings down their credit score and hurts their cash flow overall. And so it makes it hard that when they're ready to really take off and grow their business, then it makes it difficult to get capital. So if you can, try to get, a term loan earlier on, or, build a bigger nest egg before you go and start your business, just to make sure that you have enough capital to kind of get you through that period. As your business grows, you have more and more options available. I highly recommend working with a CDFI in this kind of gap between getting started and getting bank financing. CDFIs are certified community development financial institutions, and we're all certified by the Department of Treasury. And our goal is to support small businesses that don't have access to more traditional financing. So we often have more flexible underwriting guidelines and flexible um, and competitive interest rates, things of that sort, to support small businesses in kind of this in-between growth stage. There are a lot of other lenders that are out there these days, or they're not even technically lenders, so they're merchant advance companies, and so they're oftentimes buying your future receivables. So they don't fall under a lot of the same lending requirements that more traditional lenders like ourselves fall under. And we have seen a lot of small businesses end up getting financing from them, and didn't really understand how it's going to impact their business over the long run. So we have some different warning signs to kind of look out for as you're looking for financing. So the first one is unclear pricing and terms. Oftentimes, a lot of these lenders will make it really confusing about what the actual cost of the loan is. So I've seen them quote interest rates on a daily or a weekly basis, which is much different than looking at, the rates on an annual basis. Or they'll say something like, "Oh, we're going to give you 20,000, you'll pay us back 25,000 by taking 25% of your sales." So it gets really confusing and unclear about what the actual cost of the loan is. So make sure, if you get some unusual pricing, that you think twice and that you convert it to an APR. That will help you kind of compare apples to apples with other lenders to understand exactly what the true cost is of the loan overall. Aggressive or abusive broker practices, I think, go without even talking about, but just beware if you experience that. Prepayment penalties are another red flag. Generally, you don't want to pay interest on funds that you don't have outstanding. So if you can find somebody who has no prepayment penalties, that definitely helps. Some lenders these days, I've noticed, are kind of lumping it all in one fee up front, which, in turns to a prepayment penalty overall. And so just keep an eye out for different things like that. Ideally, you want to make sure that you're only paying interest on funds that you have outstanding. If approval's too easy, if they don't need many documents and they don't care, you just fill out this 5-minute application, they'll send the money to you, that's usually a big red flag. That typically means that they're counting on their ability to collect and not really concerned about your ability to pay on the loan. And so oftentimes what they do is they'll take the funds straight out of your bank account on a daily or weekly basis, or even off of each sale. So they're getting paid before you pay your employees or inventory. And sometimes that has a really negative impact on your cash flow. And so what I've seen is small business owners will get one of these loans and then they'll often have to get one on top of that and on top of that. And it just ends up strangling their cash flow. And I think it's really important to be careful with this right now. The SBA just changed their guidelines, and so now they will not refinance this type of financing. So if you get into this situation, oftentimes it can be really challenging to get out, and it could make it more difficult to get financing in the future because you're looked at more of a risky borrower if you have got financing from one of these businesses in the past. They're really short term, if they're 3-month or 6 months loans, that's something to kind of be aware of. And if they're not willing to answer any questions, that's another big red flag. If in the beginning stages they don't feel open to answering your questions or aren't really very available, what happens when you have a bad week or month and you're not able to make a payment? You want somebody to grow with, to trust, that you can lean on when you're in those difficult situations. So them being responsive and willing to answer your questions is important right off the bat. And then finally, I just have some common mistakes that I would like you to avoid. One is requesting too much or too little. It's important to try to figure out exactly what you need in order to grow your business effectively and use the funds efficiently. And so calculate your needs. If you get too much, you're paying interest on loans that you're not able to turn around and make a profit on. And so you definitely don't want to do that, and that will hurt your bottom line. But if you get too little, it can be challenging to get additional capital if you already have a loan outstanding. And so just try to find that nice balance. And I always feel like it's great if a small business owner comes to me when I was a loan consultant and gave me exactly what they need. I would oftentimes get, how much are you looking for? And then they would say, oh, how much is your max? Or how much can I qualify for, things of that sort. And then they would say they just want it for general working capital. And that would make me feel like they didn't quite do their research. They don't understand exactly how they're going to use it and how they're going to effectively grow their business with that funds, which made me feel less confident in deploying the funds. So do your homework, come in, say, I need 85,000. That's going to help me buy some equipment and hire 2 employees. And if we can't do that much, I could do, one piece of equipment and a part-time employee that'll increase my sales by 20%. And so having that really thought out about what you're going to do and what that's going to do for your business will not only help you make really solid financial decisions for your business, but will also help the lender make a better decision about what you're doing. Talked about this a little earlier, but I can't stress it enough. Mixing personal and business finances aren't great. You know, if you put a lot of business expenses on your personal credit cards or you put personal ones on your business credit cards, it may make it difficult even to get any of your credit cards refinanced. So just try to separate everything. It helps you, it helps your accountant, and it helps your lender make a good decision. Don't apply to a lot of different lenders without doing your research. A lot of lenders have basic eligibility requirements or minimum FICO scores or just things that will maybe mean that you don't qualify for them. And so just make sure you have that conversation with the lender up front, understand what their minimum FICO score is, and if it's not a good fit, just go to somebody else. On the personal side, when we're shopping for a car or a home, we generally have like a shopping window where we're able to apply with multiple people, compare offers, and make decisions like that. That's not the same case on the business side. So every time you get a hard pull of your credit, it brings down your credit score. And if you get too many pulls, then you could be declined just because the number of hard pulls you have on your credit, which is unfortunate. Oftentimes, lenders are wondering if you ended up getting a loan from them, or they're wondering why the other lenders didn't give you one. And it just makes them a little bit more hesitant to move forward. So make sure it's a good fit right off the bat before you get a hard pull of your credit. Make sure you read the fine print. As I mentioned, some people may hide, you know, things in the fine print. So make sure you understand that. Make sure you understand how you're going to pay back the loan. Make sure there's no balloon payment at the end of the loan that you weren't expecting, things of that sort. And then I would encourage you not to hide any challenges or problems. You know, sometimes we may have a bankruptcy or something in the past. Entrepreneurship is a roller coaster. There's definitely ups and downs. And sometimes that does hit our credit report or other things. We may have like a tax lien. Talk to the lender about that up front, and they'll be more receptive overall. It's worse to have them find out on the back end than to just be upfront with it. So if that's not something that they're able to do, maybe they have a rule that they have to wait 3 years after a bankruptcy is discharged, then you kind of save yourself time by not going through the whole application process when you weren't a good fit in the first place. So these are some of the key things to kind of help you get started and looking for a loan. And then I'll go ahead and hand it over to Brittany for our next section.
Yes, thank you so much, Lindsay. Thank you for such a thorough breakdown of not only how small businesses can prepare, but also those common pitfalls to avoid. So, the other part of this is that, you know, once you get the loan, we want to make sure that you're able to use it strategically to keep your business afloat and keep it growing. So, Chad, I do have a question for you. Once a loan is secured, what are the smartest ways to put those funds to work so they drive meaningful growth rather just than just covering like a short-term gap?
Sure. Yeah. And Lindsay, wow, so much a wealth of information that you provided. So I learned some stuff as well here. I'm sure the audience did. To your question, Brittany, I would say I think one of the greatest things you could do as an entrepreneur when you have received that capital is like prioritize like revenue generating activities. You know, like a lot of folks start to think about, okay, well, I can put money in marketing, or I can, you know, start to now allocate funds in these other like resource needs. I would say unless marketing is good, unless you can actually substantiate and confirm that it's going to bring in more business, I'll be very careful with that. I would really focus on how do I take, you know, 10K and multiply it to 25K, right? Or 30K. And I think if you really focus your time there and be very intentional about how you generating revenue, that allows you to start thinking about comprehensively other areas that can help fuel that initiative, right? So, and then the last part I will say on top of that is, you know, you want to like strengthen your sales and customer acquisition engines. That's really going to allow you to generate that revenue. So it's not just, okay, I have the capital, I need to focus on generating revenue or generating, new customers. It's how am I going to do that? What are the sales channels or the technology that I'm going to implement to achieve like those actual goals? So I always tell clients like reverse engineer. If you received a 10K loan, your goal is to multiply it to 25K. All right, now let's reverse engineer on how many sales or how many new customers are needed to achieve that 25K. And then now we can start to think about what processes or technologies or even people that we can leverage in order to achieve that actual financial result. So that's how I would kind of look at it after I receive that actual loan.
Yeah, that's a great point in how to make sure that you're getting that longevity and that return of interest on the money that you've acquired. Um, okay, Lindsay, my next question is for you. How can entrepreneurs balance using loan funds for growth, like marketing or expansion, but also while maintaining financial stability?
Yeah, that's a great question. I agree with Chad. I think starting with revenue generating activities is definitely helpful. That will help fund those bigger investments kind of in the future if you can make a good profit off of that. Just to add on to some of those things, I think it's really important to make sure that you have a solid foundation even before you kind of get a loan. Ideally, make sure you have a reserve in place. We recommend having about 3 to 6 months of reserve. I think this is really important because sadly, what they say is often true that lenders don't lend to you when you need the money. And so it can be really difficult to get that financing when you really need it. It's helpful to have that reserve. It's helpful for you to sleep at night, and it's helpful for you not to make knee-jerk reactions and be able to think more strategically about your business in the long term. If you do look for capital, and you didn't realize you needed it, it's going to be really expensive. There's a cost to that. So having that reserve in place can be helpful. And maybe you even put it in like a different bank account that's like further away from you, that's a little more harder to access. And you can also start small. If 3 to 6 months seems unattainable, start with, 1 month or 2 months, just slowly kind of build your way out and budget that as to move it kind of over to your reserve. It's also important to have, just important kind of foundational financial systems in place to understand your numbers, understand how you make money and what makes money, basic things of that sort, how much you need to sell in order to become profitable. Basic numbers like that are super important. So having a way to track that and analyze those numbers are a critical part before even getting the loan, because that will help you figure out what you're going to do when you get the loan. And I would just continue that as you get the loan or as you're thinking about it, make sure you're calculating your return on investment. So what is this really going to do for your business overall? And make sure that it makes sense for the amount of interest you're paying and the risk that you're taking. Is that return on investment make sense for you? Or is it best if we just do it based on our cash flow and just wait to buy a new refrigerator or something because it doesn't make sense to have, to make that decision now? Another important thing is around cash flow. And so I think it's easy to think about what's kind of happening now, but we don't always think about how this will impact our cash flow. So we may use all of the loan all at once and invest in these things that don't pay off for months or maybe years. And we didn't really account for that in our system. So always having, your cash flow available and understanding when things come in, they may go out and you may get like a great purchase order, but they may not pay you, for 90 days and they might even be late sometimes. So just make sure that you're kind of accounting for that cash flow and when it comes in to make sure that you have enough to kind of make it through that period. And then I would also encourage you to start small and think big. So I think a lot of small business owners are kind of visionaries and they're really excited about the big picture and want to go out and do it right now. And I think that's great to have that big picture thinking, but I think it's also important to kind of start small and see what works and figure out all the kinks earlier on. So if you're thinking about going into partnerships, start with one partnership and just see how that goes and see what works well and what doesn't and what you really need to scale that up and just decide if that makes sense and make sure you just have goals in mind. So if, I define success with these KPIs, or this is, exactly what success looks like for me. And that's going to really help you decide whether you want to move forward with that initiative or not. But if you start small and figure it out before ramping it up, that's really going to help save you some money and be a little bit more financially secure. And then the final one is just focusing on your different revenue streams. So it's always helpful to have reoccurring revenue coming in if at all possible. So if you can do that with your business, that helps make it so you don't have such big roller coasters over time. That can help guarantee and have that kind of cushion there for you. And consider more diverse revenue streams as you kind of go along. If you have a seasonal business, try to figure out if you need, to find another way to generate a different revenue stream to kind of make up for those low points in your business. And that'll make sure that you have that solid foundation and that you're using your funds to grow and you have the foundation to do so effectively.
Yeah, so many good points and about really understanding your data and making strategic decisions so you can gather that data in kind of a small way before you jump all in and then maybe figure out, hey, this isn't paying off the way I expected. But so many great points in that. Okay, Chad, my next question is for you. In what way can a business plan be used as part of a resilience plan? So, helping business owners weather the ups and downs or unexpected challenges of running a business that we know are always coming.
Yeah, I mean that always happens. I think Lindsay hit on a lot of these things, right? In terms of having a reserve, diversifying your revenue. I would say one of my mentors mentioned this to me before, and he was like, Chad, anytime you receive money, think about it from the perspective that it came from your pocket,
Mm.
right? And I think that mindset allows you to scrutinize every dollar that is going out, right? So I would say be very diligent on like the amount of money that you're looking to invest in certain things. And I would also put, typically like I would do like an Excel, right? Like have an Excel, like, all right, I want to do this type of initiative, right? What type of money it's going to take to do that? And then what is that return on that investment? You can then put that in AI and it will prioritize exactly like where you should focus your energy on. That's going to bring you the greatest return on the investment. I'm a very like actionable guy. So like that's something to potentially leverage. Another thing I would say is, you know, so Jeff Bezos mentioned this before, and he was like, early on in his career, one of his, mentors said, "Hey Jeff, you have a lot of great ideas, but some of your ideas, and most of them will bankrupt this company, right?" And Jeff was like, "All right, well, why you say that?" He said, "Well, sometimes like as founders, you have really great genius ideas, but like the business is not ready for it, right? So you try to do all these different elements to be innovative and bring in different people. And it's like, but the business is not calling for that. So I say that as an example to be very intentional again about like the money that you receive and how you're leveraging it. And if you think about it that way, the ideas that come about, look at them from the perspective of, do I have the right resources to actually execute on this idea? And if not, maybe I put that in like that's a future implementation that we should, potentially consider. So I would say for, you know, to that question, Brittany, to sum it up, a lot of that is just like being very, very frugal with like the money, like almost like I don't want to even spend it. Like something is going to have to make me want to spend it. And like if you start to think like that, you'll be very particular about any money going out. So that would be kind of like my response to that question.
Yes, I love the mindset of this is my money. This is coming out of my pocket because I know I could be a little stingy about that, Instead of feeling like, wow, I just got this huge infusion of cash, like
Yeah.
I'm living rich right now. So that is a super helpful mindset shift to kind of be more strategic and like you said, understanding that not every business decision or business idea, I think you and Lindsay both touched on this, is like great for your business at this time. And so you have to be strategic on what makes sense. Okay, Lindsay, what are some proactive ways business owners can use loan funds like investing in systems, savings, or infrastructure to make their businesses more adaptable and sustainable over time?
Yeah, that's a good question. And I just want to, something came to mind when Chad was talking about, acts like it's your own money. I read this book, Profit First, which is an interesting book if you're, interested in learning more about different ways to manage your finances and things of that sort. And he talks about it like a toothpaste. And he said, when you have a full toothpaste thing, you just kind of use it liberally and things of that sort. But once you get down to the bottom, you start getting really innovative. If you have kind of less to use, you start coming up with really creative, innovative solutions on how to get the toothpaste out, and you use each piece of toothpaste more effectively. And so I often kind of think of that sort that sometimes, being careful with the way you spend it helps make you become a more innovative founder and things of that sort. So just kind of along that last point. So I think that it's good to just invest on a lot of the things that you mentioned. So invest in systems or technology. I oftentimes encourage my clients to kind of track their time and see where they're spending a lot of their time and, do similar to what Chad talked about, prioritize, figure out what you can automate and what you can delegate, things of that sort, especially with the rise of AI, you can become so much more efficiently with very little. A lot of, AI systems start for free and you can kind of try out these different systems and see how much time it saves you overall. And that's going to give you more time to focus on those growth activities that we talked about earlier and those revenue generating activities. So look at kind of investing in that. I come from an accounting background, so I have to say a bookkeeping system I think is worth investing in, especially these days. A lot of it automates it for you. It makes it really simple to have real time information about your finances, and that should always kind of be your guide on where you're going and where you want to go and things of that sort. So it's worth figuring out, systems that will give you that information, including ways to kind of analyze different data, including, on your website or things of that sort, so that you can make those really informed decisions. So investing in systems or technology, I think, are well worth it. We talked about reserves and having those and the importance of those earlier, so I won't go onto that. But if you start looking more kind of in the long term, I think it makes sense to make investments on equipment that may make you much more productive. Start looking at maybe leasehold improvements that may save you in energy savings over the long run. Things of that sort may be worth looking into as you're kind of building your business. And those will help you become more sustainable and profitable in the long term.
Yeah, those are great tips for making that money really stretch and do the most for your business. So this last question I have before we get into the Q&A is for both of you, but I want to start with Chad and then Lindsay. So if you could give one piece of advice to a small business owner who just received a loan approval, what would you want them to do in that first 90 days? Chad, what are your thoughts?
All right, so founders typically probably would not like this, but I would actually almost create like a board of like mentors and things of that sort that you believe in and you invest in the company intellectually, of course, and make it so you have to prove out to them why you need to allocate capital towards certain things. I
Mhm.
found that exercise to be really helpful for me. Um, One, because it provided another like one or two thought partners and the decision making that I'm considering. And then two, like think about setting yourself up for success down the line. At some point, right, you're gonna have to speak to a board, right? If you're trying to grow your company and expand it, there's going to be a point where you have to have other folks that you need to go to get their feedback or to get their blessing. I think starting early on and to thinking about that mindset, one, you're already thinking about, I'm not considering if my company is going to succeed. It is going to succeed. So let me start put myself in position and doing the things now that I know I'm going to have to do down the line. But two, it allows you to now substantiate why you're leveraging capital towards those particular initiatives, and then you're getting validation from maybe two or three other folks that say, "Yeah, I agree, Lindsay. Yeah, I agree, Amber." I think that makes a lot of sense. That way, you also kind of can calm the anxiety too. If you're a first-time individual who just got a loan, you can say, "Okay, I've already kind of cross-referenced it with multiple people." And then the other part, again, you're getting familiar with like pitching your ideas and your thoughts to internal folks you know um, in a safe space. My wife's a therapist, so she always says safe space. So you're doing it in a safe space. So that would be my one piece of advice. I can give you more, but we don't have enough time.
But that's okay. That's a great time for me to do a little plug for Lindsay and Chad because wouldn't it be great to just have 30 minutes with them to talk about your specific business? Because you can do that. So we're going to drop those links in the chat and they will be available with the recording because you can and set up a free session and go into your specific business, which we find is really, really valuable. But thanks for queuing me up for that, Chad. All right, Lindsay, same question for you. So if you could give one piece of advice to a small business owner, they just received that loan approval, what would you want them to do in that first 90 days?
I think it's important to just come up with a plan for your money. I think it's easy to just think it's a big pot that we just pull from and, use it for everyday expenses and running the business. But I would come up with a plan, a budget for every cent of it and find out a way to track it. What does success look like for you when using that? So, investing that first $10,000, kind of tying back to what Chad was talking about, what kind of return are we looking for? And how are we going to track that and measure that over time? So I think just making sure that you have the systems to track things and then setting goals around that and tracking them and holding yourself accountable, making sure that you take that time to look back and see what worked and what didn't, and then adjust your decisions kind of accordingly.
Yeah, that is super, super helpful. And just making sure, I think this whole conversation really sets people up for not only figuring out the ways to get the loan, but also really use it strategically in the best way to support their business. Okay, so let's move into some Q&A because we have gotten some great questions in the chat. So the first question, I'm going to kick it to Chad. You mentioned revenue generating activities. Can you give some examples of what those might look like?
Yeah, all right. So someone just mentioned about they have a restaurant and they're looking to expand to another location. So I would say like for um, your particular like sector, like a nice revenue generating kind of activity would be a membership program, right? A membership program for you is advantageous because whether the folks take advantage of that membership or not, you're getting reoccurring revenue in the door before you even open up your actual operations, right? So when you're thinking about, and if there's another industry, like again, feel free to book time, we can talk about it individually, but I would say that is like an example of a revenue generating activity that would be advantageous for your business, and it will be a very complementary piece to the foods or the beverages that you offer as well. And a lot of folks, they like kind of more curated experiences, so that membership program could be exactly that. Hopefully that answers your question, Brittany.
Yeah, absolutely. So thinking about those ways that it like pairs nicely with what you're already doing, but it can kind of bring in that consistent additional income. Lindsay, in your experience, what usually is the reason why a loan is rejected for established small businesses?
Um, I would say it's generally two different things. I know we wanted to focus on one, but I feel like one of the biggest things I see these days is personal credit utilization. So a lot of times they charge up their personal credit cards. It brings down their personal credit, and then they just have limited cash flow. I think that's the most common problem that I've seen for kind of established businesses and accessing capital recently. And the other one is just kind of around credit. I think as a business, it's so hard because there's so many ups and downs, and that's bound to kind of impact your credit one way or the other. Generally, in case you have the, 6 months of reserves or whatever it is, we just, there's so many unexpecteds that we didn't plan for. And so, just working on that credit can really help improve your chances of getting a loan overall.
Yeah, that is super helpful just to have that insight. And like you said earlier, when you were helping folks kind of prepare for those lender conversations and all the documents to have ready, just to know what to expect and to prepare accordingly. So we are already almost at the top of the hour because loans, lending, it's like a full, probably 2, 3 day conversation. Now, we're not going to keep you here that long, but I do want to remind you guys of what is going to be available to you, not only the recording, so if you want to come back to this, the slides we shared at the beginning, and then also those free advising sessions that I really encourage you guys to sign up for. Get a little insight and dig deeper into your business. So if we didn't get to your question today, we don't want to leave that unanswered. We just want to give you a private forum where you can ask those questions. Um, and I really want to thank Chad and Lindsay for coming and sharing all of their expertise today. And I want to thank all of the business owners. There is only so much time in the day. We know you guys have a lot to do. And so we really appreciate that you spent a whole hour with us. So we are here to support you, and we will see you all in the next one. Thank you, guys.